Herding behavior in financial markets, but what if this age-old phenomenon is actually reshaping the very foundations of our modern economy? Today on Unlocking the Upside, we're diving into the fascinating world of market dynamics and exploring how collective behavior can lead to extraordinary market movements. I'm your host, Jeff Robinson, and I'm joined by your trusty counterpart, James.
Oh, Jeff, that's an intriguing perspective. And thanks for the introduction. You've made me sound like your sidekick. Can you give us an example of how this herding behavior has manifested recently?
Absolutely. Let's look at the GameStop saga of January 2021. We saw a stock surge an astounding 1,625% in just weeks. It's a perfect illustration of how herding behavior can create these massive, seemingly irrational market movements. But here's the kicker. This isn't just a modern phenomenon. We can trace similar patterns all the way back to the Dutch tulip mania of the 1630s.
So you're saying that despite all our technological advancements, human nature remains a constant force in the markets?
Exactly. It's this intersection of human psychology and market dynamics that makes herding behavior so fascinating to study. And thankfully, we've developed some pretty sophisticated tools to analyze it. Researchers have identified 3 distinct types of herding: informational cascades, reputational herding, and characteristic herding.
That's interesting. Can you break those down for us a bit?
Sure thing. So informational cascades occur when investors choose to follow the crowd rather than rely on their own information. It's like a snowball effect. Each person who joins the herd makes it more likely that others will follow. Reputational herding, on the other hand, is particularly relevant for professional fund managers. It's the idea that sometimes it's safer for your career to be wrong with the crowd than to be right on your own.
Well, that's a sobering thought. It really highlights the complex incentives at play in the financial world, doesn't it?
Absolutely. And then we have characteristic herding, where investors with similar traits or constraints tend to make similar decisions. For example, you might see all tech-focused funds moving in the same direction, regardless of the specific companies they're invested in.
It's amazing how these psychological factors can have such a significant impact on market movements. But what's even more impressive is how we've developed ways to actually measure this behavior quantitatively, right?
Exactly. The Christy and Huang model, for instance, uses cross-sectional standard deviation of returns to detect herding. It's based on the idea that during periods of market stress, if investors are herding, individual stock returns will cluster more closely around the market return than usual. The model uses a formula: CSSD equals the square root of the sum of the squared differences between the return on an individual stock and the market return divided by the number of stocks minus 1.
That sounds pretty complex. How does it work in practice?
Well, if this CSSD decreases during extreme market movements, it's a sign of herding behavior. It's amazing how we can use mathematics to quantify something that seems so psychological in nature. And it's not just academic. These models have real-world applications. During the GameStop episode we mentioned earlier, researchers used the Christy and Huang model and found clear evidence of herding behavior.
So how has technology changed the landscape when it comes to herding behavior?
That's a great question. Social media platforms like Reddit's Wall Street Bets created unprecedented coordination among retail investors, and platforms like Robinhood made it easier than ever for people to act on that coordination. But it's not just enabling herding. Technology is also changing how we detect and respond to it. High-frequency trading algorithms can now react to herding behavior in milliseconds, potentially amplifying its effects.
That sounds a bit scary when you think about it. Are there any notable examples of this in action?
Oh, absolutely. The flash crash in 2010 is a perfect example. The Dow dropped about 9% in minutes before recovering. It really showed how these algorithmic systems can create feedback loops that accelerate herding behavior at inhuman speeds. And that's why understanding herding behavior is so crucial for risk management in today's markets.
So what can investment professionals do to monitor and respond to herding?
Well, there are several quantitative approaches they can use. One is to use cross-sectional dispersion as a risk metric. When dispersion falls below historical averages, especially during periods of high market returns or volatility, it might signal increased herding risk. Another approach is to monitor correlation patterns. Sudden increases in average pairwise correlations across assets or sectors often indicate potential herding behavior.
That makes sense. Any other strategies?
Tracking sentiment indicators and their divergence from fundamental metrics can also be useful. It's about looking for situations where market sentiment seems to be disconnected from the underlying financial realities. This can help identify potential herding-driven market inefficiencies.
It sounds like there's a lot of data to keep track of. How can investors use this information to develop counter strategies?
Great question. One approach is to implement a robust quantitative framework for fundamental analysis. This might include multi-factor models that incorporate both fundamental and technical indicators, sentiment analysis using natural language processing, and volatility regime detection systems. But it's not just about complex models. One of the most important things is to establish clear decision-making protocols that require explicit justification for deviating from your investment thesis.
That's interesting. Can you elaborate on that a bit?
Sure, it's about being aware of your own behavior and not getting swept up in market emotions. By forcing yourself to explicitly justify any deviation from your original investment thesis, you create a pause for reflection. This can help prevent impulsive decisions driven by herding behavior.
That's great advice. It's easy to get caught up in the excitement or fear of market movements, but staying grounded in your own analysis is crucial.
Exactly. And for those who are more technically inclined, there are systematic trading strategies that can automatically exploit herding-driven mispricings. Mean reversion strategies, for instance, can be particularly effective during periods of excessive herding. These strategies essentially bet that prices will return to their fundamental values after periods of herding-driven extremes.
It's fascinating how we can use these insights not just to protect ourselves from herding behavior, but potentially profit from it as well. Are there any new challenges or opportunities on the horizon when it comes to understanding herding behavior?
Absolutely. As we look to the future, there are new challenges and opportunities emerging. The rise of passive investing, for instance, might be creating a new form of index herding. Recent research suggests that stocks included in major indices might experience correlated movements regardless of their fundamental characteristics, simply because they're part of the same index.
Oh, that's intriguing. What implications does that have for the market?
Well, it raises important questions about market efficiency and price discovery in an increasingly passive investment landscape. If stocks are moving together simply because they're in the same index, rather than based on their individual merits, it could potentially lead to mispricing and market inefficiencies. This creates both risks and opportunities for active investors who can identify these patterns.
It's amazing how the market continues to evolve, creating new forms of behavior for us to study and understand.
Absolutely, and that's really the key takeaway here. Herding behavior isn't inherently negative. It's a natural market phenomenon that can create both risks and opportunities. The key is developing the analytical tools and psychological awareness to recognize and respond to it effectively. It's about being able to step back and ask, is this movement justified by fundamentals or is it driven by herding?
That's a great point. It seems like a balance between being aware of market trends and maintaining independent thinking.
Exactly. While it's crucial to be aware of market trends and movements, it's equally important to think independently and do your own analysis. Don't just follow the herd, understand why it's moving the way it is, and make informed decisions based on your own goals and risk tolerance.
So what's your final advice for our listeners who want to navigate these herding behaviors in the market?
I'd say the most important thing is to develop a robust, systematic approach to your investment decisions. This should include quantitative analysis of market trends and sentiment, but also a strong grounding in fundamental analysis. Stay informed about market movements, but always question why they're happening. And perhaps most importantly, be aware of your own psychological biases. It's easy to get swept up in market euphoria or panic, but the most successful investors are those who can maintain their objectivity.
That's excellent advice. It really underscores the importance of both technical knowledge and emotional intelligence in investing.
Absolutely. And remember, even the most sophisticated investors can fall prey to herding behavior. It's a constant challenge to maintain independence of thought in the face of market pressures. But by being aware of these dynamics and developing strategies to counteract them, we can become more effective and resilient investors.
Well, this has been a fascinating exploration of herding behavior in financial markets. Any final thoughts before we wrap up?
I think the key thing to remember is that markets are complex systems driven by human behavior. Understanding phenomena like herding isn't just about making better investment decisions, it's about gaining insight into human nature and the collective behavior of societies. Whether you're a professional investor or just managing your personal finances, these insights can be incredibly valuable. So keep exploring, stay curious, and always think critically about market movements. That's how we navigate the fascinating world of finance and market behavior.
Thanks for listening, everyone. We'll see you next time on Unlocking the Upside.